Well, good afternoon, everybody. It is my pleasure to welcome you to the role of capital markets in accelerating the development of critical minerals. A tightly kept secret, but it is clear that this is going to be the most popular panel discussion of the conference. My name is Philip Lindop. I am responsible for the mining investment banking team at Barclays. And quite frankly, we have an extraordinary and very well qualified panel. Two public asset managers, just to simplify, two private asset managers, one facilitator or service provider to the asset management industry, and last but not least, a CEO who has taken advantage of pretty much every financing structure and product available to the mining industry. So I'm going to ask each of my panelists to introduce themselves very briefly, and then we will kick off. George, over to you.
Thank you, Philip. Good afternoon, everyone. I'm George Cheveley, and I'm a portfolio manager with 91. I run their resources funds and gold funds. We're a long-only asset manager. I'm based in London, but we have a big team in South Africa. And I've been working in metals and mining since 1990.
Mike.
Thank you. Mike Barton. I'm the Deputy CEO of Orion and spend most of my time as the managing partner on the mine finance funds, which are focused on providing packages of financing to mining companies.
Owen?
Thank you, Philip. And my name is Owen Hegarty. And thank you very much for the opportunity to be here. Congratulations to the FMF on a wonderful showing, actually, by the way, in terms of number of people and so on. I'm Executive Chairman and a founder, owner, driver of EMR Capital. We're a private equity group, only mining. Philip, I've simply been in the mining industry all of my career, if you can call it that. And we have capital to deploy, so we're open for business. EMR Capital. Thank you.
Excellent. Vivi.
Yeah, I'm Vivi. Very nice meeting you. I work for Power Corporation of Canada. We're a conglomerate in financial services across North America, Europe, and Asia. We in total run about 3 trillion Canadian dollar through asset managers. And I'm the Asia CEO for Power Corp. I also sit as a chairwoman for China Asset Management Company, which is the second largest mutual fund company in China.
Great. Good afternoon, everyone. I'm Peter Hughes. I'm CEO and founder of Apex Group. We're the facilitator of the capital markets. The business is 13,000 people in 51 countries, creating fund structures for asset managers, servicing $3.5 trillion of assets. So we're the leading asset servicer of alternative assets, obviously, which is what mining is as an asset class. We're here in Saudi. We have a full team with CMA regulatory licenses to facilitate the inbound flow of foreign capital to co-invest into mining projects.
And John.
Thanks, Philip. I'm the CEO of Capstone Copper. We're a copper mining company with operations in the US, Mexico, Chile. During the past year, we've just ramped up 2 new copper projects. During the coming year, we're about to expand one of those further, Monteverde. And we're going to be raising the capital to build our next major project in Chile, which is the Santo Domingo project, for $2.5 billion. And I'd say sort of in the evolution of Capstone, from the time that we set out as a private company, being Mantos Copper, we've probably experienced, as Philip said, sort of every form of financing that's available to mining companies. And so looking forward to this discussion.
Very good. Well, it's been a fantastic day, and we've heard all sorts of views and assertions around the different types of capital providers, sovereign wealth funds, retail investors, obviously institutional investors, and pension funds. You know, they're very, very different investment strategies that you will hear about today, and there are very different investment structures that we will hear about. But I think really at the heart of this discussion is really whether the capital markets, the financing markets are enabling or disenabling the development of and the production of critical minerals. And I suppose we will come in due course to the role of the companies and their management teams and even the intrinsic quality of their assets to contribute to all of these discussions. So, I am going to start with George. George, are mining projects and companies capital constrained?
I think it very much depends on the project and the company, but I think if you've got a good project, good company, well run, the capital is available. It's never easy, and investors are clearly cautious about the mining industry, and you just have to look at examples like currently Barrick's problems in Mali and some of the things that happen in First Quantum in Panama to see why investors are cautious. There's a lot of risks out there, and therefore there's a lot of reasons not to invest, but if you get the right project in the right jurisdiction with the right team, generally money will come.
Michael, do you agree with that?
I think they are capital constrained, so I was just going to say yes to your no. They are capital constrained. I agree with George that the let's call them the easier projects or the easier assets can get financing, but the industry is inherently constrained. People aren't spending enough capital, be that the majors redeploying capital into the ground, be that funding sources from the private sector and the public sector, be that governments. So there is an inherent constraint on the flow of funds versus what we need it to be. So yes, but you can still finance certain projects, but there's a whole load more that need to be financed. So we need to get more capital into the sector.
Oh, and if I can come to you, do you agree with the two views that have been presented? And for the projects that may struggle to attract capital, do you think that is the right answer, or is that a failing of the system?
Well, there's no usual story here, Philip. There's no magic or silver bullet associated with actually raising the capital, and things tend to move in waves a bit. I think you've actually got to tap all sources. You've got to go to all sources. You've got to work the street. You've got to pound the pavement. You've got to wear out a lot of shoe leather, so as to speak, to actually raise that capital. So there's no substitute for out there telling your story, and you should never tire of telling a good story. And in terms of actually raising the capital for our projects, whether it's in the fund per se, where you need co-investment, or whether it's a single asset that we have that needs to raise capital, whether it's a private or public, Philip, you need to make sure that you are able to tick all of the boxes in terms of the things that the asset must have, and all of the boxes in terms of the things that you must avoid, so as to speak. And I'm very happy to run through all of those for you, but really it's a question, particularly when it comes to the asset class. I mean, management is one thing, and you've got some very good examples on this panel, by the way, of some excellent money managers and operational managers. But when it comes to the asset itself, it must have the tons and scale, it must have the grade and quality, it must have a regular process to be able to process the material, it must have low cost, long life, lots of upside, all the L's, so as to speak. It must be in a stable and secure domain, jurisdictionally, where you can actually work with everybody, the regulator as well as the community. And it must be, as we say in private equity, Philip, must be eminently exitable. In other words, you want people out there who want those assets more than you do.
Very interesting. Vivi, you bring a unique perspective amongst your many responsibilities and understanding of the domestic asset management industry within China. How do you think, what is the role of governments in supporting the flow of private capital, particularly into the mining industry, in your view?
That's a very interesting question. So first of all, I think there's no doubt there is a very strong appetite, looking from my side of the world, that the Chinese capital will be extremely interested in investing in critical minerals. And especially with China trying to play a key role in energy transition and trying to build capabilities across the entire supply chain is very obvious. And to put this in perspective, and I think it's an open book that China is now 1/3 of the global EV production, 1/3 of the production in aerospace, And as well, if you look at the ODI investment cumulatively in China, by 2024, it's already reached 190 billion USD, and this number is still growing accelerately. So all those are positive signs with the real demand being there. And having said that, I have seen ample amount of government support in all spectrums going into the sector for mineral investments. And to highlight a few areas, first of all, I think we have the world's second largest, capital market, and there's active products and passive product, and that has been growing at double-digit growth for the past decade. And lately, in recent years, there has been 18 ETF product formulated, speculate focus on mineral investments or like critical mineral sectors. And I have seen this trend to gradually to start to go up. So that's one. The other, don't underestimate, I think, don't undermine the fact that there are all type of Chinese banks, and they are very good at providing, I'd say, soft loans and patient capitals in the sector. And I think that has been undermined by a lot of the global miners. And the other one is really, I'd say, on infrastructure know-hows. I see the government play a very strong role in supporting infrastructure know-hows, building ports, roads, utilities. And lastly, I think you have a lot of the government strengths to support ESG focus as well in recent years. So there's whole spectrum things that the government's trying to support into the system.
If we may, we'll come back to expand on some of those points. Peter, I'd just like to bring you in here. You gave a very impressive statistic of what quantum of capital flow your firm enables. As it relates to the mining industry and even to critical minerals, can you share with us some of the trends and opportunities that you're seeing as those flows come through your organization?
Yes, of course. I think it's been hard on the mining sector, particularly from an image or perception. The whole ESG movement over the last sort of 5 or 6 years has meant that the large pension allocators have felt that it's not really appropriate to allocate into mining as an asset class. But coming here, really opens your eyes a little bit and to see how important this is in terms of the minerals piece and how the transition to green energy is going to be. And I think it's the image and the perception of the industry which needs to really be focused on and changed collaboratively to really bring that flow back in. In terms of where we're seeing opportunity and where we're seeing flow, obviously here is a key hub, particularly. We do a lot of work in South Africa as well. So it's those two areas as well as Australia. Obviously we service the EMR funds here for the last 10 years as well, so we have a happy client on stage too. He's not looking that happy, but I think he is. So that's how we're focused on seeing, and really it's a shift and really to think about actually a new wave of investors coming into the asset class, away from the institutional money, which is really tied up with the bureaucracy of running a pension fund, and thinking about how do you get it into the wealth channels, the retail channels, right, and getting it into a form there that it becomes investable with a new set of investors.
Interesting. Well, John, you've had an extraordinary career in a big company at Anglo American, and then taking a single asset, developing that asset, building projects, expanding, merging, and financing all of that with partners of all sorts along the way. Before we get into how you did all of that and perhaps even what you did to achieve that, as you've sort of occupied various parts of the mining ecosystem, from sort of very small junior to now, I think, a very well-established large copper company, what's your impression around those other projects and those other companies that are competing for the capital represented on the stage today? Is it your view that the mining industry is capital constrained?
Yeah, it's a very good question, and in my view, there's plenty of capital available for low-risk, high-returning projects. Unfortunately, for most investors, when they look at the sector, their view is often different from the mining company's view as to what those risks actually mean, what the consequences are going to be, and ultimately whether those risks will ultimately reduce or even destroy those returns that are being put in front of them. And so, I think the real issue is what are those risks and how do the companies manage those risks? And it's really about whether it's permitting. Sorry, can you still hear me? Whether it's about permitting, environmental, social issues, operational issues, technical issues, jurisdiction. The list of risks that mining companies are faced with goes on. Certainly, my experience has been if one is able to manage and mitigate those risks, there's absolutely no shortage of capital available. We're very fortunate. I think the operations and the projects that we have in Capstone are in good jurisdictions. They're fully permitted. They're in areas where we have very strong local support. And so really the challenge we're faced with is more one of capital allocation and project execution. And those are risks that sit within our own sort of ability to manage. So, I think the point was made, the industry needs to improve its image. There's absolutely no doubt that is the case. We need to sell the case that the world needs a hell of a lot more of these critical metals, and the lead times to bring them on are very, very significant. But I also think the type of capital to be raised depends very much on where a company is in terms of its stages of evolution and what its growth strategy is. When we grew initially as a private company, we were able to put 100% of our focus into growth. And that served us extremely well. As a publicly listed company, there are a lot more avenues available in terms of raising capital, but there are also the obligations of ensuring we match our growth with returns to shareholders. And so, I think it's very dependent on where you are and what you're actually trying to put forward as your investment proposition.
Michael, if I may come to you, as you've obviously been a long-standing partner of what is now Capstone. Well, I sort of have a view as to the answer to my question, but what is the advantage of being a private capital partner in your mind as it relates to the mining industry, and particularly some of the earlier stage projects in the mining industry over the public sector? John touched on some of those. But
yeah, so I think the biggest single advantage is flexibility. We can tailor our investments with a very broad mandate really to what the situation needs. Now we have a particularly broad mandate because we are able to invest it across a capital structure. So it means that the range of opportunities where we can deploy could be all the way from debt and credit at one side, through every mezzanine form of financing, through equity and offtake financing. So we can do that whole gamut, which means we can really focus in as a private company because we're not having to explain that on, let's call it, an ongoing, regular, quarterly basis to investors. We can actually take a longer term view, a multi-year view, and back ourselves to tailor the investment in the right way to, in the case of Mantos Copper, as was, we can tailor that to make sure that, as John said, everything at that point in time went into growth, because we're not having to report back dividends or anything like that. So I think that's really the advantage of private capital, in a sense, in that you can really tailor the investment to what's needed at that point in time.
To contrast that, George, and to maybe take the conversation back into another direction, there's been a lot of talk about critical minerals. Is that a thing? Does that compute from the perspective of your investment strategy?
Well, no, clearly. Frankly, to start with, the whole critical minerals really started with the US government a few years ago. And I have to say it's been hugely helpful, because at that point, everybody saw mining as just a dirty business. ESG was at a peak. Nobody wanted to look at mining even. And actually it was the US government with their critical minerals policy and list which really highlighted, and several other governments since, that these minerals are required to make things and they are critical. So the actual sort of the term critical minerals has been incredibly helpful to essentially explain to people and make that link between what mining does and the goods people use. So in a very broad sense, it's been very good. I think where I sometimes get frustrated is people come to me and say, I want to talk about critical minerals. I say, what do you mean? And they say, lithium, rare earths, nickel, everything goes in a battery. And I go, okay, but shall we not talk about iron ore, copper and aluminium? Because those markets are 10, 20 times the size and they're equally critical. And they go, oh, well, yeah, okay, but, I sort of got interested in rare earths. You go, like, no, let's be clear here. I mean, a lot of minerals are critical, but if you want to invest in big markets, then copper, aluminium and iron ore are way bigger than anything else. And by the way, energy dwarfs all of them.
Yep.
But so I think sometimes the problem with critical minerals is people start focusing on some very small areas where actually we need to remember that minerals we all know and love are equally critical.
So Vivi, just jumping around a little, you talked about the different types of capital that China has contributed to the mining industry. Is there a chance, do you think, that private investors, not government or state institutions, that private investors will be able to invest in international mining assets?
I definitely think so, and I think this trend has been happening. And we talk about the demand side, which is very well aware. However, I do think Chinese financial market also offers a full suite of access to the capital, which is more undermined by the market. So, as I mentioned, we have the second largest world capital market, which provide both public and private products. And then we also have all sorts of banks at a relatively very low interest rate that is willing to support financings for large mining projects because it fits very well with the national mandate for going energy independency. And China is not rich on oil and natural gas, and we have to find leapfrogs in other ways. And the other spectrum we need to look at is actually direct strategic partnerships, not just with SOEs, but also with private companies in China. That has become a very commonly used and popular way where the Chinese company would come in normally backed by the Chinese banks on long-term patient capital and cheap capital relatively. And as well, they give you the access of the buyer market and they provide very good infrastructure know-hows. And lastly, which is one emerging trend, Philip, where I find is that the private equity funds in China has gradually in recent years start to look into the space of critical minerals. This is because they're also shifting around from the investment thesis of going from purely consumption-based sort of structure to innovative manufacturers to energy transitions. So looking to the upstream, that's become critical minerals as well. So I do think there is a range of investment channels that can be available in China that the international miners might not have tackled in enough. That's why we need to keep the dialogue open nowadays.
Very well said. Well, Owen, if I may bring this back to you, you've heard a few of your colleagues' perspectives. Of course, Australia remains one of the last great markets for capital for mining. Are there any different perspectives that you would like to share with the audience today in relation to your seat in Australia as it pertains to the questions we've been debating?
Yeah. Okay. And thank you, Philip, for that. Just coming back to the point that you made and the point that George made there about critical minerals and metals. Really, because governments are looking to encourage that for one reason or another to ensure the energy transition is successful and so on. As far as we're concerned, everything that we do in terms of all the metals and minerals we have, they're all critical. It's critical that they actually have the tons, it's critical that they have the grade, it's critical that they have the process, absolutely critical that they're low cost, long life, lots of upside. So that's criticality as far as we are concerned. So it depends, it's a bit like criticality is in the eye of the beholder here, Philip, I think to that extent. But when it comes to, and the point that John made a little bit earlier about the risks these days associated with associated with mining, the regulatory risk, the permitting risk, the licensing risk, the approvals risk are, very high. So that's a risk that needs to be mitigated, and it's a risk that needs to be one way or another removed if possible. But it's to a large extent it's sort of out of your hands. In other words, it's the regulator. So if the regulator and the governments were very well-meaning, of course, if they want to see more and more critical minerals and metals developed to ensure that the energy transition is successful one way or another over a period of time, and they can reach the net zero targets in 2030 and 2035 and 2050 and so on, then they really need to actually work at a number of areas, including mobility of capital, Philip. But one of those areas has to be the red tape, the green tape, the various other multicoloured tapes that they tend to impose. I'm not saying that it's simple or easy, but it is their job. It's work that they can do if they're going to encourage us to do more, whether it's in whatever state, whether it's in Australia, or whether it's in the US, or it's in Canada, China, anywhere else in Africa. They can do that work. It's in their hands, and it's in our hands to the extent to encourage them to do that. Philip.
So I'd like to end with a couple of the same question to our panelists on the left, Peter and John. As observers of capital flows and prolific users of capital sources, what advice do you have for the capital managers and the investors behind them for doing a better job in identifying and profiting from investing in the mining sector? What's your experience of dealing with investors, with the managers of capital?
Maybe I can go first, and I think certainly, I think this is at a point in time where actually investing is going to change, not the traditional form of investing, but people are beginning to think about investing into tokens of assets. Private equity funds are beginning to tokenize their share classes, and that can bring much more liquidity. And so rather than being locked into a fund which is investing into mining for 7 to 10 or even longer years, actually you can be able to get liquidity daily, and that's a shift that's coming as some of these funds are beginning to go onto blockchain. And actually we've had even this week inquiries to put certain types of physical metals and tokenize them, so then people can borrow against those tokens and use them as collateral. So I think the way of investing into this asset class will change quite a lot, and I think as asset managers need to be prepared to embrace that change to get the next wave of future capital.
Interesting. John, your experience is obviously slightly different, but you've dealt with endless banks, capital providers of various sorts. What would you say is frustrating, and what could they do better?
Well, I think the commodity industry has always been highly cyclical. And I think one of the things that has burnt our industry is the fact that most capital becomes available at the top of the cycle. And generally there's quite a long lead time, and these lead times are getting longer and longer to develop mining projects. And so what that means is by the time these investments actually start generating, product and revenue, you're back at the trough in the cycle. And so the ultimate return on that investment is horrible. And I've experienced raising capital at the bottom of a cycle. It's very obvious that one should raise capital then, one should build mines then, and one should bring the mines into the up part of the cycle. And the question is, why doesn't everybody just do it? And I can tell you it's because it's extraordinarily difficult to raise money when everybody's totally depressed and slashing their wrists at the bottom of the cycle. If you look at today, where we are right now I started off by saying, yes, there's capital available for high returning projects with low risk. That represents a very, very small part of what is needed in terms of, I think, most critical metals, but I can talk particularly to copper over the next 20, 30, 40 years. And, there really is an imperative to be able to decarbonize the planet, slow down global warming, to actually bring on all the technologies and the renewable energy that we need in a relatively short time frame. Unfortunately, our market is still somewhat imbalanced, so long-term pricing doesn't actually reflect the sort of incentive price that you need to bring on the next generation of lower quality projects. And what that means is when we finally hit that point when demand exceeds supply and the long-term pricing achieves the level needed to incentivize these projects, you have somewhere then between a 10 and 20 year lead time before you're actually going to see the first ton of copper coming out those projects. And that to me is really problematic. Right now the copper pipeline is about as thin as it's been in the past 30 years. And that's not a good place to be when you see how much copper is actually going to be needed over the next 30 years. So to me the real question is, what can we do to actually start thinking about what copper pricing has to be to invest in projects that, using today's prices, probably don't look that great, but in a few years' time are going to be absolutely needed.
Well, that's a very inspiring challenge to us and to the audience. I haven't been given the red flag yet, so perhaps what I'll ask everyone to do is just summarize, if you can, in less than a minute, your reflections on not just the constraints of capital for the industry, but opportunities that you see and that you would like to pursue. George, would you like to go first?
Yeah, no, very quickly. I mean, look, these markets are cyclical, and John just explained very well how difficult it is to raise money in the bottom, and then the money comes in just as things are going up. I think we're entering a new cycle, and I think we are going to see prices start to move up. The actual signal for that is companies start buying each other because they have a very different view of long-term prices to the market. And we are starting to see that happen. So, and that last happened in sort of 03-04 and the super cycle, and I think that is a signal that things are starting to move. So it feels almost negative. Companies aren't developing, they're just buying others. But that's a sign that people are bullish and things are starting. And I think that's what we're going to see. And then we enter a very strong cycle.
Excellent. Michael?
Yeah, I mean, I would agree with George that I think we're moving into a cyclical upswing, which is obviously positive. I would also say, just coming to somewhere like this, I've been coming since this started, and each year there's, record turnout. So that's indicative of a lot more people in Saudi and the broader region being interested in things. So there's new capital available, there's new capital interested. It's just a case of making sure that finds its way into the right pockets to deploy that capital and into then the right projects.
Owen, final word?
Yes, just a quick one. I think Philip, this particular conference and the gathering, and indeed this august panel here, is sort of living proof that people want to do more in the industry. And from the supply side, and we're supply side people basically. We do contribute a small amount to demand, but we can contribute more to supply. So I think it's living proof that people are interested and want to do more, number one. Secondly, and again real quick, we do actually buy in, I think, to the super region in terms of the Saudi longer term objectives here, and it's a sustainable suite of objectives, the Africa, Middle East and into the greater Asia or Central Asian region in terms of longer term mining and minerals processing development. So okay with all of that, I think it's being very well led by Saudi, definitely. I think one thing, Philip, that we do need to do, and we're all one way or another involved in capital markets here, whether it be equity capital or debt capital, private capital, public capital, whatever it happens to be. You mentioned it at the very beginning. There is it to become more mobile, particularly when it comes to this region, because many of the parts of the region we're talking about, whilst there is capital available, it's been less going into mining per se, so less experience there. So that's where the ASXs and the TSXs and the AIMs and the various other platforms come in terms of encouraging that capital to be more mobile, and that will get you more supply. It'll get you more capital, get you more supply of those critical minerals, including copper, that we need more of.
Very good, Owen. Vivi, in a minute, if you could.
So I think this is definitely a rising sector, and obviously the capital, at least from my side of the world, will continue to chase or explore investment opportunities. Where I also see is we need to keep the collaboration and the dialogue open in different continents because commodity is a sector that it cannot really be regionalized. And also, on the other side, I also think there's a great shortage of the talents, the talent pools in mining exploration, at least from the side I came from. So that will be also very important to keep the dialogue open. Yeah.
Peter and then John.
Yes, I'm not sure why it will be cyclical going forward. I get it has been in the past, but I think certainly these are scarce resources, limited supply always. And if we raise capital in a different way and we change the image of what people are investing into and actually investing for the future benefit of the planet rather than destroying it, I think that'll have a big effect, and it won't be cyclical going forward if you can get a bigger, broader set of investors investing into the sector rather than a narrow set that invest into it currently.
John?
Yeah, I think from the industry perspective, the best thing that we can do is just make ourselves more investable, and make sure that the general public understands the criticality of these minerals and metals and why they're needed for decarbonization, why they're needed to improve the sort of climate change situation that we're faced with. But also the industry itself needs to, in many respects, achieve better standards, and I think have been achieved historically. It doesn't help if you're replacing one problem with another problem. And I think the industry also needs to do a better job of delivering the returns that it promises, and that means delivering the projects that they promise on the budget and on the schedule that they promise to do, and then delivering the operations. And once we get to that point, I think there'll be less cynicism around investing in the sector.
Much harder than it looks, I'm sure. Well, I've absolutely enjoyed this conversation. It's been a great privilege to be here at the FMF. I hope the audience has, and please join me in thanking our panelists.
No, thank you. It's okay to thank ourselves, I think.